with Russell Real Estate, and today I wanted to go over an article, short article from Housing Wire, titled "Mortgage Rates Trend Down Amid Lower Monetary Fiscal Pressures." So we've seen quite a spike in interest rates for the 30-year fixed rate loans and all mortgage interest rates for different loan products over the past couple of weeks. And the source that I use is actually Mortgage News Daily, and they basically have a composite of what the average 30-year fixed rate loan is across the United States, and I saw that number jump over 7% within the past week or so, which basically is like a 6-month high. Because we've been hovering around the 6.5% range for most of this year. It's been going up and down, but that's what we've been seeing. So basically, what this says is that mortgage rates are trending back down as of today, June 2nd. I checked Mortgage News Daily, and I saw that the average 30-year fix was at 6.85%. So that's good. We're down, 30 basis points basically from the peak of just a week ago. And basically what this says is mortgage rates jumped last week amid a debt ceiling impasse with the federal government and expectations of another federal funds rate hike. However, rates have started to reverse course over the past few days following news of a debt agreement and signals that the Federal Reserve may pause their hikes. So it sounds like they have come to an agreement between the House and President Biden to basically push or kick the can down the road, and they're suspending the debt limit until January of 2025. So that's good news for mortgage rates. And then also, the expectation now is that the Federal Reserve might not increase the federal funds rate after their next meeting, which is coming up in about 10 days or so. And basically, they might just press pause this time before going back up, and increasing it another quarter point the next time they meet. So that would also be good news for mortgage rates and then for lenders in general. So what it's saying for the housing market is that the 30-year fixed rate mortgage averaged 6.79 as of June 1st, which was up 22 basis points or 0.22% from last week when it was 6.57. And then comparing this to June of 2022, we are at 5.09 because, again, we started 2022 at 3.1-ish% for the average 30-year fixed, and then just rapidly increased as the year progressed. Obviously, you could see by the time we got to June last year, we are just over 5%. By the time we got to late October, early November, we were actually in the 7.15 range, basically. So yeah, I mean, comparing rates to last year, we're definitely higher, but it seems like the volatility mostly has subsided a little bit, with the exception of this past week, just because people were getting a little nervous about that debt ceiling, and just factoring in, is the Federal Reserve going to hike their rates again? So yeah, you can see right here, according to Mortgage News Daily, that's the source that I follow. The 30-year fixed rate loan for conventional loans hit 7.14% last week on Friday. It was down to 6.88 yesterday when this article was written. Like I said, down to 6.85 right now. And then Optimal Blue, which is another company that tracks this, they were down at 6.72% yesterday from 6.85%, so down 13 basis points there. So that's the good news as far as what we're expecting moving forward. So the 10-year Treasury yield that is something that is basically a leading indicator for what mortgage rates are going to do. And they basically move in parallel with each other. Typically, the 10-year treasury yield has about a 200 basis point spread from the mortgage rates, meaning if it was at 3.81%, mortgage rates for a 30-year fix would be at 5.81. Unfortunately, that spread has grown over the past year or so, just with more economic volatility. So we're actually seeing that spread closer to 300 basis points. So if you want to kind of guess and gauge where interest rates are going to go, look at that 10-year treasury yield, add about 3% to that, and that's probably what we're going to be around then. Of course, it says that according to Realtor.com economist, the successful passage of that debt ceiling deal between President Biden and the House Speaker does not provide an absolute safeguard against negative financial and economic consequences, which, of course, that makes sense. It says once the deal is reached, the U.S. government is expected to quickly increase issuance of Treasury bills, which has the potential to cause short-term liquidity challenges at banks. So banks are, they were hit hard with the federal funds rate and what the Federal Reserve has been doing. Now that the debt ceiling is being pushed back, government's expected to increase the issuance of or giving out treasury bills. And basically what that's saying is it might actually uh, attract businesses and households to reallocate their funds to purchase those because those are going to be considered pretty safe. Nobody's expecting the U.S. government to fail as far as paying back their T-bills or anything like that. So that's why people will maybe rush out to get those because they are going to be higher yielding. And then basically what it's saying there and why it might hurt banks or challenge banks is because they banks want people to deposit their money with them. And if people are going out and buying T-bills instead, because those T-bills are offering higher yields and obviously it's supposed to be a safer government debt, then banks might feel compelled to raise their interest rates that they're paying to get people to deposit money into their bank, just because they'll have to make it more appealing for depositors to actually keep their money there. And by doing that, they'll raise their interest rates, which hurts their overall profit margins because they're still getting hit with the federal funds rate as far as borrowing for them. But so their profit margins might be squeezed there, but they might try to make up for it by increasing rates, making it more expensive for loan products offered by banks, including business loans and personal loans. So something to just keep in mind as we move forward. Again, I like to look at it from a housing perspective, which overall it's good for housing, but there are some potential consequences that come with that. So that's just my 2 cents on this little article from Housing Wire. If you have any questions or if you wanted to basically comment and share your opinion, if it's the same or different, feel free to do so below. Otherwise, have a great day.